our presenters. Since we are running out of time, it's good to start on time. Let's see, your J. Anush. Is Anush here? No. Rasheed and Seung. Yeah, I think just Anush, do you know if something happened or?
Not exactly sure. I'll check my email, but I don't
Maybe
see
we
him.
maybe we can start with Seung then, and when he comes.
Oh, Anush is here now. Perfect. Okay. So I think everybody's here. Rasheed is here. Anush is here. Kim, you're here or no?
Can you guys hear me?
Yeah. So I think everybody's here. I think we can
That
get
sounded
started.
like Anush speaking. Turn on your video, Anush. Yeah.
Oh, okay. There's Perry. Hi, Perry. I've opted not to use the synthetic background. I hope that's okay.
It's fine.
Yeah. What are we gonna do, Anush? Can't force it, can we?
Hi, Jay.
Well, let's start. Well, hi everyone. Thanks for joining us on our second day of the Money View Symposium. So I'm really excited to moderate our second presentation sessions with these 4 interesting papers that combine the Money View perspective with in a political and historical context. So each presenter will have 10 minutes to present. I'll let you know when you have 5 minutes and 1 minute left with these things. So just look at me so we can keep tight. So well, Anush, please, the floor is yours.
Okay, great, thanks. I am going to try and share the screen. All good? Everyone can see that?
We can just see your screen.
Okay. Oh, you can't see what I'm sharing?
No.
Second. I full screened it, so can you see it now?
Now we can.
Okay, let me do that then. You can see that, yeah?
Yes.
Great. Okay, so listen, thanks so much for the invitation. And sorry I couldn't make yesterday. I think the invitation seems to be going to spam, but I'll stay. It's 7:30 in the evening in Bombay here, so I'll try and stay for as long as I can. Just briefly, I'm just finished a book on which I'm calling A Political Theory of Money, which is sort of like a social theory talking about the nature of money and building very centrally off of a lot of Perry's work. I'm not going to present the entire theory here. I've shared chapter 1 of the book with Jay, and I look forward to his comments. I'm just going to actually address one question that the book addresses, which of course is quite central to the money view and Perry's own work, namely why monetary systems are hierarchical. A political theory of money, just by way of background very quickly, is an attempt to kind of get at some of these questions, these kind of big philosophical questions, almost, or social theoretical questions. I'm an anthropologist by training, although I have obviously an interest in political economy. And this book is an attempt at social theory, not so much at economics, although, so it's what kind of thing an interest rate is rather than what drives interest rates. But there are several money questions on the screen. I won't go through all of them. Some are familiar. Why does money have value? What is it? It's a fiat or a credit instrument. If money is a credit instrument, what is it promised to pay, et cetera, et cetera. And this sort of theory in this book, which is comprised of a front half, which is sort of theoretical, and the second half, which is more case study based, is meant to sort of provide an answer to these kinds of questions. As I say, I'm just going to zoom in on the one question today in the interest of time, why are money trade systems hierarchical? The sort of big picture, and a lot of the answers, I think, to many of these questions can be found in sort of this idea, which is the sort of one big idea of the book, if you like, which is that political contracts lock money to value, but and this is good for very many theories of value. This is not a book about a theory of value, but it has elements of only certain kinds of theories of value that is somewhat not post-classical, shall we say, would be compatible with such a theory of money. And I can talk about that if people are interested, but this is the idea that money is sort of locked to value through these balance sheets, and it has a commercial sort of front end, but a political back end. And we'll hopefully make sense of that as we go on. But let's get into the question for today: why are money systems hierarchical? No prizes for who this quote is from. Let me read it out. There is a simple hierarchy of market makers that go along with the hierarchy of instruments. This is obviously Perry 2012, I think it is, in his inherent hierarchy piece. There are 3 prices of money in the simple hierarchy: exchange rate, par, and interest rate. Now this is my emphasis added. These prices are the quantitative link between layers of qualitatively differentiated assets. The market makers who quote these prices, in effect, straddle the layers of the hierarchy and using their own balance sheets to knit those differentiated layers into a coherent whole, end quote. Those emphasis is all mine. So in a sense, what drives hierarchy for Perry is the fact that there are qualitative distinctions, which of course we can't perceive because they are in a sense hidden behind the market making activity of various credit market makers, whereby qualitative differences between layers in a hierarchical system are made commensurate by rendering them as differences in price. And we don't see the quality, we just see these prices moving around. And when the system breaks down, maybe this is apparent, but in normal times it isn't. But this sort of begs a theoretical question. What is driving these qualitative differences? If hierarchy is, this is almost, it's an economist question, which is fine. It's trying to understand system dynamics. But from a social theoretic point of view, how does one theoretically account for these qualitative differences? What is driving these? One can point to the differences, but one has to account for them theoretically. So that's what I try and do. And one of the answers, or the main answer I have for this, is this idea of robust mutualization at scale, which I'm going to try and break down very quickly. So if the question is what drives qualitative differences in layers of hierarchy, the answer is robust mutualization at scale. So what is mutualization? What do I mean by robustness? Scale obviously matters, and therefore robust mutualization becomes a kind of one way of accounting for hierarchy. So what do I mean by mutualization? Basically a kind of contracting together of balance sheets. We're familiar with this idea of interlocking balance sheets from Perry's work, right? One unit's asset is another's liability. One way of thinking about this colloquially in this kind of physicalist language that we use is to talk about pooling, but it's actually, pooling is a little more, it's like literally putting things together. But it's actually in relational terms or in creditory terms, it makes more sense to think about mutualization, where smaller units are mutualized into bigger ones, and this can happen either on public balance sheets or in private balance sheets. So private or commercial or economic mutualization looks like, think of the standard bank balance sheet above. Depositors, lend to banks, and that loan is their deposit asset. Likewise, the flip side of that is banks accumulate deposit liabilities, and they do that at scale. So along this sort of margin, you have a mutualization between depositors' balance sheets and banks' balance sheets to create this sort of mega balance sheet that is the bank's balance sheet that is superordinately able to solve liquidity problems and the survival constraint downstream. But this can also happen, the same logic on the one level, but different on another, can happen in public balance sheets. So you can have political mutualization, whereby a political relationship anchors in a certain kind of cash flow, as opposed to depository, which are obviously just a commercial relationship. And so citizens who have tax liabilities, which are obviously exchanged in a political contract, vis-a-vis representation and democracy, legitimacy, and so on, nevertheless, that literally cashes out as tax flow to the state, but those are sort of politically anchored, and that is obviously forms the asset base of the state. So already you can see that so if that is mutualization, this aggregation of balance sheets, this pooling of balance sheets, then you can see it sort of comes in two qualitatively distinct forms. There is economic mutualization and political mutualization, and I want to assert, in fact, that there is, if you like, a hierarchy or asymmetry between the two. That economic mutualization is sort of less robust. This is what I mean by robustness: is that it is less robust than political contracting or political mutualization. And so, what do I mean by robustness? Robustness is the answer to the question or set of questions: how coercive is the mutualized contract? Is it easy to get out of? What is the cost of contract violation? Do you go to jail or you just get a fine? How quickly can mutualization unravel? If you think about the distinction between civil law and criminal law, this is one is also getting at civil law being a kind of easier thing to violate than criminal law, because of course if you don't pay your taxes, there's one penalty, and if you violate a civil law, that's a civil contract, that's another kind of penalty. For those who know some social theory, this is akin to the distinction that Durkheim has between mechanical and organic solidarity. I'll just point to that without explaining what that is. Think about also in the financial crisis, we had this phenomenon of treasury fails, where in the treasury repo market, people were like, those who were holding the collateral in the repo transaction, rather than unwind that, return the collateral and take the money back, they're like, actually, I'm going to hold on to the collateral. And people couldn't get access to this collateral because there was a hoarding of collateral. The final leg of the repo transaction failed. And that is a kind of commercial contract melting away under the heat and pressure of a kind of crisis, obviously akin to a kind of bank run, versus the through the cycle robustness of tax flows, which, because they are politically anchored to the state, nothing is certain. Benjamin Franklin said, more certain than death and taxes. So of course there's a coercive element there, but that coercion is exchanged for legitimacy in a political contract. So that's mutualization.
Anush,
I'm almost done.
Yes.
Almost done.
Okay.
So I'll pass over scale because that's obvious. So this is the upshot, is that you basically get, when you put scale together with robustness and mutualization, you get a kind of typology of balance sheets. And states emerge from that because they're not only politically robust, but they occur at higher scales. And so that makes us account for differences like this. The EU and the US are both about 25% of world GDP, but the US has, world money, and the EU doesn't, because it has a similar scale, but it is not as robustly mutualized. These are just a list of balance sheets which are both public and private, and you can see the red ones are private, the black ones are public. You can see that hierarchy of scale through, but also the robustness showing up. I'll end here with this, which is one of my favorite quote, which is the kind of kernel of all of this idea, and which is this lovely quote from one of my favorite articles of Perry's, which is "The State as a Financial Intermediary." I won't read it out because we're out of time, but basically the idea is that we all are mutualizing part of our own balance sheets. We're all own part of each other because the state owns a part of us and we own, in a sense, the state. So thanks very much. Sorry if I went over time.
It was just fine. Thank you, Anush, for this very interesting presentation. I found very interesting ideas. So let's move on for the next presenter, Seung, the money view and the history of the Eurodollar market. So do you have some slides to share, Seung? No, great.
Okay. Let me just. Okay, I assume you can see my screen and you can hear my voice. Okay, thanks for the invitation of this wonderful symposium. Here, this is actually a kind of a revised version of my latest paper on the revisionist account on the history of the Eurobond market, but I think has a relevance with the Paris the money view. So I will start with it. So according to the money view, there's a yesterday it was called the natural, but I would say international hierarchy of money and credit, which puts on the dollar at the top. I think well, we can kind of slightly replace the term dollar into the Eurodollar market, because the well, in this international or global format in the market, the dollar at the top also, I think, also means the Eurodollar. So there's quite interesting character, mainly political or social, maybe cultural aspects of this dominance of a certain national currency within the hierarchy, which Perry said, it is in this hierarchy I submit that is the origin of most discontent. Agents who operate at the lowest level, whether individuals or entire countries, feel their subordinate status as an injustice. By rights, men are equal and sovereigns are equal, but in practice, the liabilities of men and the liabilities of sovereigns are deeply unequal. Some privileged few issue money while everyone else issues promise to pay money. So, well, I'm going to provide you kind of a historical case where there has been so much discontent with the supremacy of a national currency in a global financial market. So, if we may narrow it down with the post-World War II period, or the Bretton Woods, there was the tripping dilemma. And also there was a very serious political contestation from French President de Gaulle regarding the exorbitant privilege that the US abuses its power over the US dollar. And then there was the actual case, which has pretty much condemned or criticized by, for example, Europeans, mainly French, the Nixon Schacht, which unilaterally abandoned the commitment of Bretton Woods of a gold exchange standard. But there were other voices regarding the sort of the practice or the realities of the Bretton Woods, at least in the 1960s. Well, Perry has a great research on the Kinderberger, the focus on the minority view on the way in which Bretton Woods function, practically de facto dollar standard. Well, there's a different assumption, different logic and analysis, but so-called de facto dollar standard was shared with other contemporary economists or practitioners. I would say two examples of Milton Friedman. In his pretty much famous, not really famous, but in his confidential letter to then President-elect Richard Nixon in 1968, by the end of 1968, he sent a letter to Nixon saying that we're in the de facto dollar standard, so we don't have to worry about the balance of payments burdens or commitment. I will come back to it later. And there's another practitioner, a British banker, very famous British banker, as one of the founding father of the Eurodollar market, George Bolton. In his famous speech in 1968, he said, the world is literally on dollar standard. So let me see, kind of give you kind of a big picture how the dollar has been the dominant currency for international transaction, particularly in the Eurobonds or the global capital market. As you can see from this blue line, the US dollar has been the dominant currency for denomination when it comes to the international banks to float or issue a international bond. So from this presentation, I would like to provide you kind of a historical case of how the US dollar became the dominant. There has been some literature like I can grade and others providing that there was the sheer size of a US economy or the power of a US economy. But thank you, I got 5 minutes. But I will say from this paper, I would like to argue that if we can see, maybe following the money view, the two different, sort of ambivalence of US dollar. First, as a national currency, as well as global currency, we can understand that the US dollar have been invited. So with the history of the Eurobond market or the international politics of currency for domination for Eurobonds, I will try to explain the way in which the Europeans, particularly French or British, have accepted the standing of the dollar as the dominant currency for the world capital market. So I will divide into three parts. First part is the origins of the Eurobond market. The second is the challenge of the Deutschmark, and the third part is and the Bretton Woods and the continued dominance of US dollar. So from the first part, the birth of Eurobond market, well, I will just skip a couple of things. There was a big debate over the Atlantic between US and the Western Europe, how to handle the continuance of US balance of payment deficit. Europeans demanded US should introduce austerity policies according to the classical understanding of the balance of payments. But there was a very interesting point. I would argue that the assumption of policy has changed in the post-war area. There was no, for the national government, it was not possible to abandon the domestic economy. In other words, domestic economy was prioritized in US, was the same to the Western Europe. So they debated how to address the issue. And the policy coordination attempt at the OECD had failed because each part, US and Western Europe, prioritized the domestic interest or national interest. In this kind of stalemate, there were attempts by European banks to replace dollar as the currency for denomination for Eurobonds. But all these attempts had been failed because of the reluctance of European monetary authorities to allow private bankers to mobilize their currencies to float international bond or Eurobonds because they worried about the internationalization of their currencies. So upon the introduction of a US capital control policies such as the IET, interest equalization tax, it was obvious that there was only one feasible currency to issue Eurobond. It was the dollar. So the Eurodollar was a tacit compromise between the different conflicts of interest, which was the prioritization of national economy. For the US part, it was not acceptable to introduce sort of austerity measures. For the Europeans, it was not acceptable for them to allow internationalization of their currency, which might bring the inflationary effects upon the domestic economy. So moving on to the second part, well, despite the continued or introduction of capital control policies, the US payments deficit continued. And hence, the Johnson administration introduced additional mandatory system of restrictions on capital outflows. Because of that policy, the US multinational corporations found that the Euro capital market, the Eurobond market in Europe was useful for them to finance their overseas operations. This caused the political contestation, such as the exorbitant privilege, because Europeans believe that the capital market in their own territory or in Europe was facilitating the expansion of the US corporations. So they believe that the US companies are sucking out their money to compete against their own country or national industries. So, but was there any alternative to the US dollar? There was a possible candidate, Deutschmark, but the West German government was worried about the internationalization as well as their policy orientation towards the internationalization of the Deutschmark was purely on the balance of payments policy. And as one observed, they didn't want their currency to assume the position of a key currency. So, and moreover, later, Eurodollar bonds became an attractive source for finance, even for French. So French condemned about the Eurodollar market and Eurobond market. But at the same time, because of their retardedness of a domestic banking system, French government allowed their nationalized industry or their car makers such as Citroën to tap on the Eurobond market. So Eurobond market became a very resourceful source for funding. So in 1969, Milton Friedman said that the world is literally or de facto on a dollar standard, under which the US has no
I'm
balance of payments
sorry.
problem.
I'll just ask you to conclude.
Yeah. So I mean, the third part is end of Bretton Woods. It was same, but I just want to say one thing. With the inauguration of the Nixon administration, there was an interesting policy orientation changes that the U.S. was now able to kind of decide to explicitly pursue national interests. So it decided to phase out IT and all the capital control policies in order to benefit the domestic economy. And the European response was rather retreat into the more stringent controls during the period of 1970 and 1973. Under such circumstances or regulatory differences, it was once again the international investor returned to the Eurobond market, particularly Eurobonds denominated in dollars or the Eurodollars. Therefore, I'll just conclude that the dollar was invited to play a function as a reserve currency because it proved its usefulness. Thereby, if I may say, the U.S. dollar not only became in the format of Eurodollars, was not simply a national currency, but also became a global currency to be on the top of the hierarchy that Perry suggests in his Money View. Sorry about the delay, and then thank you.
Thank you. I'm in a terrible position here to interrupt the interesting presentation, so I'm sorry in advance. But let's move on to the third presentation. So Rasheed, please, the floor is yours.
Thanks so much. Let me see if I can do this. I cannot share until you stop sharing, Seung-Woo. Can you see my screen?
Yes.
Yeah, perfect. All right. So yeah, good morning, afternoon, evening. I see I have 10 minutes to explain not only the US stock market bubble, the 1929 crash, and also to relate my inquiry to elements of the money view. I've also just realized how short 10 minutes is, or maybe 9 minutes now. And anyway, here goes. I'd like to jump right in the middle of the money view and start with the hierarchy of money. And I think hopefully this is very familiar to everyone already. Going down the pyramid in good times is really easy, right? And in 1929, we're talking about a quasi gold standard. So, we can convert gold into dollars and dollars into bank deposits and bank deposit securities at whatever we decide we want to call par, fixed rates in most cases. And gold being the top of the pyramid here. The idea is here that we can put dollars in the bank and get dollars back in good times. If you buy bonds at par, floating rate bonds at par, we can get them back at par in good times. But I'd like to flip this a little bit on its head. When we're going back now, in this case, down the inverted pyramid at the risk of sort of outright heresy to show what happens when we have one of the layers become detached from the other layers. So I also want to substitute securities in this case for the New York Stock Exchange stocks. Whoops, that didn't work out very well. There we go. Let's try that again. You can also see I have very, very poor animation skills, which is why I became a hedge fund manager rather than a graphic designer. So, so we're here. So we're New York stocks. And my basic thesis is as follows. Bank credit was severely restricted in 1928, 1929. But the existence of a new private credit feedback loop in the market allowed the New York stock market to become top heavy and look like this, completely detached from the bank credit market. And what that means is when in crises, we see the inevitability of crises, we see it difficult to convert back to par. It's even more difficult when the securities market has become so detached from the bank credit market that we have an overcrowded theater and almost no exit back into more liquidity. I think I've heard someone say somewhere liquidity kills you quick. And as a result, there's an inevitability of this pyramid to topple over and the financial system to collapse. So let's bring that into the private credit market and the bubble. And it's difficult to exaggerate the role of private credit. This is well known. Kindleberger covered it. Perry covered it in, I think, 2010 as well, just hinting at the idea that the 1928-29 bull market was a shadow credit market. And indeed, it looks like it was. 30 to 40% of all stock market purchases were on credit by October 1929. That compares to 3% of stocks that are margined today. And this is especially interesting as stock exchange credit has been shown to be at least a partial culprit in crashes at levels of credit way below 30 to 40%. In the crash of 1987, lending was 3%, 5%, I should say. And in China in 2015, it was approximately 10%. So what we know is that private credit grew about 3 times, threefold, from about 2.5, 3 billion to 8.5 billion by October 1929. And this kind of stock market leverage never occurred again. At the same time, formal bank credit was scarce. The economy was slowing and deflation had a negative impact on real rates. Bank participation in the speculative markets was limited. So lending to the stock market was limited by banks due to the real bills doctrine. And the result, lending to that market by banks hardly moved. And that's on the same scale as the red line. We have bank credit almost unchanged throughout the entire period. And that can be seen in rates. Think about rates here as being the price of credit. And from pretty much all time, other than crises, thank you, to 1928, we see the rate on loans to the stock market pretty much tracking other bank credit rates almost perfectly. But something happened in the end of 1928, and we see a gigantic rise, huge rise in the cost of credit for loans to the stock market. And what happened was that what should have happened was that bank lending or lending to the stock market should have been curtailed because the borrowers don't want to do it anymore, right? When rates are really high, we don't want to borrow as much. But the fact here, though, is also that the stock market was going up so much, 60% a year on average, that, to be honest, borrowing at any rate was rational for buyers of stocks. So at first, as more leverage was demanded rationally, the rate on those loans went up, which is what I expect. And you'd have a credit constrained supply curve as expected. But after 1928, and what you find is that the interest rate on these securities loans was almost 100% correlated to the other money market rates and to the volume of loans supplied or demanded, which is BL others here, non-bank credit to the stock market. But then something funny happened. We kind of plateau on rates even as the volume of lending to the stock market goes up. And what I propose, or what I suggest happened, is that we have a new source of supply. So we get these supply curves moving out. And you can see that at this point, we have no relationship, R squared of pretty much 0, between bank credit rates and the rates on stock market loans. Well, where was the source of supply coming from? And where it was coming from was an arbitrage, or a shadow banking market. And as the bull market moved on, progressed, we get interest rates on the loans, the black line, on bonds falling from around 9% to about 5%. This is also true of the cost of equity of firms, which is about 5% cost of capital at this time. I used that Shiller's CAPE to look at that. But you can see the dotted line is the cost of the securities loans, and they're rising above firms' cost of capital. And that created an arbitrage in the market where corporations could borrow long and lend short. And this is not, this is actually taken from a 1933 report by Wilfred Eidemann, and just shows how this arbitrage could have worked, or did work. In fact, we're going to see it. There's good evidence that it did. So we take a bank, and it makes a loan to a broker, and that broker makes a loan to an investor. And that investor then buys a new issue security. But that corporate then uses that money, rather than to put it into plant and equipment and inventory. I remember the economy was slowing by this point, makes a broker's loan, becomes a bank, shadow bank, in fact. It then makes a second margin. That broker can now make a margin loan to that investor or another investor, it doesn't matter which, and so on, and so on, and so on. A new corporate can take that money and invest back in the market. This is a bit like fractional reserve banking, right? We're only limited by how much the investors have initial margin to put up. And again, like I said, this is not just theory. This actually did happen. We have lots of documentation in the press and in things like Senate committee investigations. Companies were able to invest hundreds of millions of their newly raised capital into the broker's loan market, into the loan market. Electric Bond and Share averaged $101 million per day in 1929. Standard Oil of New Jersey, $100 million per day. It doesn't take a lot of $100 million per day to get to this $4 billion of non-bank lending, backing 30% of all of the stock market. And so finally to the crash itself. Well, what is happening here, right? We've got an unprecedented amount of lending.
Oops.
Yeah. Okay. No worries. So this is it. And the story here is that the crash itself, what's interesting here is everyone thinks because there was so much credit building up, that somehow the withdrawal of that credit caused the crash. This is a common thing. I listened to a paper just the other day on this exact topic, so this is not changed. But rates fell as the crash occurred. They didn't rise, right? In the panic of about 07, 1920, 1921, in 2007, 2008, and 2009, we got a rise in the cost of shadow credit, not a fall. And what happened in 1929 was the cost of shadow credit went down. Not only did it go down, but there's lots of evidence that shows that there wasn't any huge withdrawal of credit supply. I just circled here, out of reduced supply, there was some reduced supply, but there was always enough credit to meet demand. And I've got 3 examples of that from Black Thursday and Black Monday to show that this was indeed the case, that this was an example of a rational exit of equity buyers from the market who had to unwind their leverage. But as we know, because there was so much leverage, we now let's get back to the pyramid. We've lost that conversion to par, right? We're trying to get to the exits. And because this is a shadow banking system, collateralized mark-to-market lending, right? Short-term borrowing on long-term capital markets assets mark-to-market, we get, this liquidity crisis that it's rational, but it wasn't the credit market that pulled out of the stock market. It was the stock market that demanded less credit. And it couldn't have ended another way because of the amount of leverage being used, but it was actually a rational reaction to a plateauing and lowering of the stock market from about the middle of the summer to end of September, rather than a credit crisis. Thank you.
Thank you. So let's move forward to the next presentation. So Jay, please go ahead.
Okay, everybody can see my screen?
Yes.
Perfect. Well, thank you very much for your attention. The title of my presentation is Behind the Curtain of the Old Wizard, the German Economic Recovery under Hjalmar Schacht, 1933 to 1937. And this is something I'm now revisiting for this Money and View Symposium. It's part of my master thesis that I handed in 2017, I believe. It's quite a fascinating story, and there's a lot of points to cover. And I know we only have 10 minutes, so let me also put on my own timer before I forget. Here we go. So let me just start with a quote, because I think it's quite interesting. It's right here on the front. On many occasions, I have told those who put their faith in systems that monetary policy is an art. Art and systems contradict each other. And I think that's already a nice theme for us to get into. Now, here you see a couple pictures of Schacht and Hitler. And Schacht on the lower end is on trial at the Nuremberg trials. And you can see how the American prosecutor Robert Jackson characterizes Schacht. He says it was Schacht, the facade of, it was Schacht, the facade of starched respectability, who in the early days provided the window dressing, the bait for the hesitant, and whose wizardry later made it possible for Hitler to finance the colossal rearmaments program and to do it secretly. And Schacht himself says about his dealings, he says, yes, money really is a quite uncanny thing. Several times in my public life, I was brought face to face with its uncanny quality because I was able to master it. I earned myself the title of magician or wizard. Of course, this only happened because of this day. Up until this day, many of my measures have remained incomprehensible to a large number of people. Often it takes a long time for the sense and import of an act to become apparent. And now let me just sort of preface this before I run out of time. I want to sort of start with the conclusion of my talk, because I already told you that 1933 is of course one of the German economy is in a complete disarray, and I think thanks to Rasheed, we kind of know some reason why. But I also would like to sort of start with Schacht's own conclusion of what happened. And there's two important aspects that I think I want to bring out to our attention, which I think I might not be able to cover in all detail I would like right now. But the first thing is that we have to consider both domestic and international aspects, which I think the hierarchy of money is a perfect example of how we bring into the same perspective domestic issues of finance and international. And I think the interwar period is characterized by primarily international financial problems, the reparations questions in Germany, the war debts of the British, and right up until the stock crash that Rasheed just talked about, the American extension of credit after the Dawes Plan to Germany to kind of make this real go. And allow me just now to let Schacht explain in own words what he thinks the challenge was that he faced. When at the beginning of the 1930s, unemployment figures reached the 7 million limit, the question again was how to cut the ground from under the feet of communism. The introduction of common sense, if daring methods of finance enabled us to provide work for the unemployed in a little under 3 years without endangering the currency. So he's talking about introducing finance credit without creating inflation. That's what he's talking about here. And of course, we're under the impression of the hyperinflation that happened not even a decade before. He's also talking about, in the second quote, the third success was the restoration of the balance of trade through the introduction of bilateral and offset agreements with those countries whose economy was complementary to the German. And by abandoning the prevailing multilateral most favored nation policy, which had operated solely in the interests of those countries enjoying a strong economic position. On all three occasions, I was able to break new ground. I abandoned the central bank's so-called classic discount policy. I embarked on a program of productivity expansion, not dependent on savings, that is, on restriction of capital expenditure, but on actual creation of new money. I rejected the trading methods which classic economic theories had bequeathed on us. So here already, I think we have the crux of the story, which I'm now going to dive into. And this is important because we cannot disentangle domestic story from the international story. I think these two have to be looked at in one piece. And and my sort of approach to this is to trying to understand what Schacht was thinking and which framework he was applying. And my conclusion is part of my first part of the master's, but I won't have any time to dive into, that he indeed had a hierarchy of money in the back of his mind. He was trained as a banker. He understood these types of issues very well. So let's look very quickly into who he was before I get into his policies. I think the thing that I would like to sort of get into is that he has a PhD in economics, which is kind of important for the basic question that I want to get into. He was a respectable banker. Initially, he was a left liberal, and before he became central banker under Hitler, he was also a central banker previously, and he dealt with the hyperinflation with his plans there. But unfortunately, we can't get into this any further. But allow me again to sort of emphasize one important problem, which is he was both an economist, he has a doctorate in economics, but he was also a banker. And I think this basic problem that we were faced at the time is, of course, Say's law. He knew that in order to actually have investment, we need prior savings. That was the prevailing economic theory. But as a banker, he also knew that you'd have credit creation prior to needing savings to invest. So that's an important aspect that I develop in one of the chapters. So he's not necessarily constrained and beholden to Say's law, and as a banker, he kind of knows that, but that is beside the point. But it is very important to emphasize right now the economic conditions that Germany is facing, which is Germany has no access to capital. Domestic capital markets have, of course, been obliterated by the inflation 10 years prior. And after the crash that Rasheed just talked about, we don't have any access primarily to American credit anymore, which is also dried up and collapsed. We have much idle capacity in the economy, and we have huge unemployment. And an additional problem for Germany is, of course, that international trade is also collapsing, and Germany's ability to sort of earn foreign currency to make its payments on its debts and reparations is also completely impaired. And Schacht keeps harping on this point over and over, that this is a huge problem. Germany's currency is overvalued because there's competitive devaluations, and we kind of know that Germany has a fear of inflation, particularly in this time. So this is a really difficult situation. And let's look at how Schacht threads the needle here in order to get at the main point of reflating the German economy. So the main instrument that he uses domestically is the Mayfield bill. And that's a very interesting bill because it's actually a money market instrument. It's mercantile credit, and it's based on a real bills doctrine notion that it's not non-inflationary, because that's one concern he had, because it would be introduced directly to produce an increased production. The structure of this bill is very interesting. It has a 3-month maturity, but the holder of these bills, which is industry, which are paid with these bills, have the option to roll it over and continue holding it for up to 5 years. It bears 4% interest, And the interesting part about this that we can de facto see that a money market instrument bootstraps a capital market instrument in this way. So he's kind of bootstrapping a capital market with this instrument. I hope you follow with this argument, but I'll show you in a second what this means. The interesting point we'll get into in a second, that this bill becomes a means of payment within the wholesale sector. And we need to really pay attention to that because that's a really important point. So let me just quickly look at what Schacht says. Just look at the very top quote. Banks, savings banks and firms could hold on to them, which is Mayfield bills, in their safes exactly as if they were cash. Okay. And his economic minister that follows basically says that we have Mayfield bills being used as, I have it, thanks Nathalie, I have one more minute. Mayfield bills being used as means of settlement in the wholesale sector. So this is basically a point that's really important that I just want to emphasize, because Schacht has a basic problem to solve here, which is to create a wedge between the wholesale sector, which is the industrial sector, which is now being introduced and infused with credit, and the retail sector, the consumer sector, the wage bearers, which are also competing with. Yeah, so sorry, my alarm is going off here too. So sorry, I'm already over time. But to just make it completely clear what the point is that Schacht is dealing with on the domestic side, is that there is a wedge that he's driving between money creation and expansion, credit infusion with the Mayfield bills inside the industrial sector, while suppressing wage growth and having forced savings schemes to suck excess purchasing power out of the economy. And why does he do that? Because immediately the next problem becomes apparent, which is for this production, this increase in production, there's a scarcity of foreign currency to buy resources. And that's a problem that I just want to quickly dive into because, and I'm almost coming to an end, Nathalie, don't worry, I'm aware of time. This managing, so imagine as soon as the economy is starting to pick up again with the introduction of these Mayfield bills, the German economy is not self-sufficient with the necessary input factors, which is coal and steel, which have now are no longer within German territory for rearmament that's happening. So immediately, even though this introduction of bills is working well, he's coming up against a real constraint of lack of foreign currency. And there are many, many different policies that are being introduced, but they follow a very clear line of limiting, doing everything he can along 4 categories to manage the lack of foreign exchange. I'll just summarize them. He's trying to do everything to increase exports. He uses export subsidies for that. He's decreasing imports. He's increasing foreign funds in Germany by creating block market accounts. So exporters to Germany, foreign exporters cannot take easily the money out of Germany. They are incentivized to buy things in Germany. And then, for example, the Jews that are already being persecuted are leaving the country cannot take their money out of the country, the capital of the country. But that is not enough. So these policies are not enough, and he has to move into another level, which is to create bilateral agreements with other countries. So effectively what's happening here, he's abandoning the dollar, gold, pound system, and he's creating bilateral agreements with about 25 countries in which settlement happens primarily in clearing accounts, and settlement is done in German currency. And because Germany is often not able to deliver immediately on the promise, it's acquiring resources from foreign partners, but its products are not immediately available. Schacht also says, and that's the final thing where I'll end on, understands that this in itself also is a credit creation operation to have these bilateral agreements. So let me just read this quickly. So far as monetary policy is concerned, the crucial aspect of bilateral trade is the fact that it takes place without any transfer of money. and an inevitable complement was the necessity to grant credit. The foreign supplier was not always able to obtain immediate delivery of German product, which he wanted. Now, this whole system all worked up until this point of 1937. NAFO bills were introduced. The system was sort of managed, but as soon as Germany hit full capacity, any new introduction of credit became inflationary. And that's basically where he asked Hitler to stop the introduction of new credit of NAFO bills into the economy. And he wrote this letter, just basically make him and the entire directorate of the Reichsbank said, we can no longer guarantee that additional credits will increase production. It will only increase inflation. And upon this letter, he was fired by Hitler. And that's where he had to exit, basically. But Hitler then completely revamped the Reichsbank and took control of it because Schacht had outlived his usefulness. But that's, in short, I just want to sort of emphasize that the interconnectedness about the hierarchy of money, the different wedges that had to be placed between the international and domestic currency, and the wedge between the wholesale and retail sector, in order to reflate the economy only in the industrial sector by suppressing the retail sector. So that's basically where I'll end. Sorry for going over time. I hope it was clear enough.
Thank you, Jay. Yes, it's hard to have 4 papers in an hour. So we have 5 minutes to discussion, but since the next session is only in half an hour, maybe we can extend to the break, through the break, if you can stay here. We have assigned commentators, right, for each paper. So maybe if we start with Anush's papers, I think you were designated to comment on it, right, Jay?
Yeah, and let me be very brief. And I think what I would like to just start with is that, Anush, I would like to invite you again to give a more elaborate presentation on your chapter in your book, because obviously we can't do justice.
Thanks, I'll be happy to.
But I found this extremely interesting because we've had these discussions yesterday already. And let me just, in addition to the whole framework is something that I was not aware, and I think the questions you ask are fundamental to, why, for instance, we talked yesterday about hierarchy of money. Why is it natural? How do we ground the idea that this is an inherent or natural hierarchy, as Perry calls it, into something that we don't have to just accept, but have to actually motivate? And I think your approach was extremely important. And I think from the paper and from a discussion I saw you give at another conference, I think the main thrust is that we have to look at the demos as the people, and it goes with the mutualization as being the primary criteria for the robustness and for the legitimization for how the hierarchy is ordered. And I think in this discussion, it was very interesting and striking about how thin the theorizing actually is, not just with, obviously Perry's here. Perry has obviously had these discussions with you and has not done much more to theorize around this, but this is also the case for other related theories like MMT, which also use hierarchy money. And I think for the discussion of MMT and Minsky that you introduced, the survival constraint, and the state, the discussion of the state is extremely interesting for those who don't. This was a point that was extremely important to me because I've never thought of, I've never really applied Perry's money view to the state as such. But let me just say that actually the state is constantly never facing a solvency issue in most cases, but it's always facing a liquidity problem. And how do we straddle that issue is something I never really thought about. I just wanted to throw that out there. But also I think you also point at a under theorizing in MMT, for example, which is credit as fiat. And there's also a little bit of a thinness to the theory there. And I think this whole discussion is actually really productive because Obviously, Perry doesn't take sides in the chartalist versus medalist debate. He sort of emphasizes at the lower ends of practice, and sort of both sides are sometimes right. But I think no side is always right. But I think the discussion and the points you introduce are extremely valuable for us to dig into the various theories that are sort of being introduced and currently debated. And I think the depth that you bring is really refreshing, Anush. And I just wanted to leave it at that before I run out of time. Thanks again.
Thanks, Jay. I'll discuss it more with you, definitely. Thanks for those very nice comments. Thank you.
And as if you like to respond or take a comment on Jay's paper, I think you can go ahead.
Should I respond to Jay's comments on my paper or my comments on Jay's paper?
Maybe both, if you can, or what
Sure,
do you
sure.
prefer?
Sure. No, let me say that. Let me just quickly say that I like the framing of it as an application of the money view to the state. I never quite thought it like I think of it as a kind of financial theory of the state, and it certainly is an application in that sense of Perry to the state. I think Perry has a side in the MMT debate. Perry couldn't speak for himself, obviously, but he definitely has a side. And I will just say that things look very different from the developing country, emerging market point of view, right? I think you can have MMT in one country, but and that's only ever going to be the sort of hegemon. For everyone else, the states routinely have a survival constraint. But the centrality is not so much the people, so much as the people indexing a qualitative difference in the kind of mutualization. And so there are big banks and there are big, financial corporations and big, which are, as I briefly showed earlier, which are of inordinate scale. I mean, Berkshire Hathaway's balance sheet is about the size of India's. But scale is one thing, and the way in which these are mutualized, these balance sheets are mutualized, is a different thing. And just taking a lead from Perry in terms of trying to account for that qualitative difference, I think what accounts for that qualitative difference is a political contract. Not that that's the A all and B all, but it enables us to get some purchase on hierarchy. Let me quickly then, while I have the mic, make 2 or 3 points, or 3 or 4 quick points on Jay's fascinating paper. I learned a lot about Schacht, and I don't know the literature around this as much as I probably should. And I want to emphasize one phrase that Jay used in the paper that he didn't such use in the presentation, which is thinking like a banker. And I want to say that it's not just thinking like a banker, which Schacht was obviously doing that, but he was thinking like a state banker. And as a merchant banker to the state, and to obviously a state preparing for war. And I think the apart from the historical interest, I think the real interesting approach to this could be, what does this tell us about, what does this method of war finance, in a sense, tell us about peace finance? And I have 3 or 4 brief points to make about this. One is that, and I have a little bit on this in the book, is that central banking is kind of like central planning. And thinking like a banker at the scale of the economy means controlling the economy, right? So just to complete and extend that thought that you had, Jay, in terms of if you're going to think like a banker at the level of the state, that means controlling economic activity in that kind of central planning way. Now, that is particular to war finance, but in Germany, of course, finance capital is, you already have a very top-heavy, bank-oriented system of a variety of capitalism, if you like. And so even in peacetime, there is a kind of private planning function that German banks obviously undertook in German capitalism, and Schacht kind of took that to scale. I will also note that, even in a country like America today, in advanced Anglo-American forms of capitalism, the overnight interest rate is not a market price, right? It's a price set by a government agency. So that's another way in which central banking is sort of like central planning. The second point is the banking school inspiration on starting with payments, right? Banking school always starts from the idea of payments as money as a settlement instrument that settles debts. chartless, MMT, they start with unit of account or sovereign power or something like that. The banking school always starts with money's ability to end the chain of payments. But the other bit about payments that's super interesting in the thesis, which I read in its entirety, is Zoltan and James Sweeney had this nice line during the crisis where they said that a supply chain is a payments chain is a payment chain in reverse, right? So the idea that the payment system, the payments are not just randomly arranged, but they cluster in supply chains, and these supply chains are sort of like mini payment communities. And because they are mini payment communities where there's a heavy interlocking of balance sheets, that enables them, in a sense, to that's the precondition almost for them to issue their own kind of monetary liability. And these were these lovely MIFO bills. I was crying out for a balance sheet, Jay. You needed a MIFO bill balance sheet in there somewhere. Now, this is particular, again, war finance brings this out. This is always there. We have interconnected supply chains in various ways, but the war finance bit brings this into kind of closer kind of relief. The supply chain part, the global supply chain versus autarky, of course, pure autarky, much to the upsetness of the Nazis, is impossible. But different kinds of globalization are possible, and I don't want self-sufficiency or autarky to get a bad name here. Don't forget, of course, even Keynes was for a certain kind of self-sufficiency, not just the Nazis. So there's sort of good and bad self-sufficiency, and I think we can think about a different kind of self-sufficiency, especially today, where you have these global supply chains wrapping around the world 17 times and warming up the planet. I think there's different kinds of self-sufficiency that we can think about. And finally, on the methodological point, this lovely quote from Schacht, which you sort of, it's so important that you in fact quoted twice, this idea that you can't run an economy by formulas alone. The banking school, and that you have to adapt to circumstance and so on and so forth. He says scientific considerations are important, but you cannot reduce the economy to these kind of axioms. The banking school can be kind of lampooned or dismissed as kind of just a bunch of practitioners hanging out there, but it's never that. It's never unreflected practice, right? These are practitioners, and they sort of reflect and understand the warp and weft of the system, and thereby the real magicians can innovate. And that's, of course, what Schacht does to quite telling effect. In conclusion, I couldn't help but notice the similarity between these bilateral trade relationships that he has and the settlement happening on the books of the central banks. This is a Hawala transaction. You guys know what Hawala is, right? This basically it's a form of money laundering where you have these Hawala brokers, and it's a way of moving money without moving money. I deposit money to my Hawala broker here, and I tell my friend in the next country to collect the money from there. No money has passed borders, but money has exchanged hands because the Hawala brokers are kind of debiting and crediting internally. And so Schacht basically is turning the central banking system into an internal Hawala broking system, which again is out of necessity. But super interesting paper, and thank you for giving me the opportunity to read it.
Thank you for the comments, Jay. I'll let you respond at the end. Maybe we can move to the Seung comments on Rasheed's paper.
Yeah, sure. Thanks, Anush, very much for your comments.
So I'm pretty sure that the audiences in this room has a great question to Rasheed's paper, so I will be very brief. So first of all, this paper, I think the contribution lays in the way in which he presented how the shadow banking system that currently under scrutiny has played a great role in the development of a great crash in 1929. It also reminds me of the kind of an interesting debate in the 1970s. If I may ask Rasheed kind of opportunity to expand the kind of space, because this paper has examined within the kind of a domestic level, thereby the policy implication goes to the Federal Reserve. But there has been some discussion in Rasheed's paper that the relevance or relation between 1929 and 2008. So I was wondering about how can we kind of expand the kind of shadow banking's role in the at global level in the development of financial crisis in 2009. Having said that, I was thinking of, while reading your paper, I was thinking of the interesting debate regarding the nature of Eurodollar market in the 1970s, the credit creation issues. So I don't really have any kind of my own idea, but I have examined how Milton Friedman and then Fred Klopstock have debated on the nature of the credit creation of Eurodollar market, and that's kind of the interesting point I'll develop from based on your paper. And from a historian's view, because you provide, it's very interesting. Always the debate or historical analysis or new approach to 1929 always has two things, I believe. The first is the assumption on the nature of financial market and the great crash. And second part is always the policy implications. I think it's kind of big question at the moment, but I was kind of invite Rasheed and others to what if we were the sort of U.S. congressmen or politicians in 1932, for example, because based on the diagnosis of the crash of 1929, the U.S. Congress introduced various types of regulatory framework, which became the foundation of the post-war period, or as well as until the sort of days of deregulation until 1980s. And then let's say if we had known back then about the kind of shadow banking activities, and we were kind of entitled or we were assigned to handle this issue, what would be the kind of imagination of the policy response to the issue of shadow banking? It will be divided into two parts, I believe. First, on the domestic level. So it could be the role or design the role of the Fed. And second is the global level. Well, back then there was a BIS. During this period, the role was but different, but we can imagine how we can kind of sort of make the architecture as a global response to the shadow banking system. Thank you.
Rasheed, since you are going to have the mic now, if you want to quickly respond and then make comments on Seung's paper, sure. Please go ahead.
Yeah, absolutely. Yeah, thanks for those comments. I think you really touched on, I think, what is the key element of the paper that wasn't mentioned at all in the presentation, which is that, well, what did the Fed do? What could it have done? And what indeed lessons do that bring? What can we take away from that in 2007, 8, and indeed maybe future crises? And what I take away from this is, Friedman and Schwartz's argument was the Fed raised rates too late, well, not early enough, and then too late. And when I look at this through shadow banking, I see that is it's not a very good accusation, right? If they would have raised rates, the market was already slowing. It would have hit the real economy harder. But because this market had no bank input, it wouldn't have done anything to the bank market. Well, but that's all they had. They barely had that. And they tried moral suasion. And I think that could have worked. The idea where, if it was just a bank market, the banks probably would have listened. They didn't, in fact, for various reasons, but they could have. And I think that's what is interesting here is that, bold regulation, and that's an oxymoron, right? The idea that we are going to fight the bank lobbyists to create a safe, financial system. It hasn't. The evidence isn't there that's happened. But macroprudential regulation here would have worked. And in fact, in 1931, the NYSE did ban non-bank lending, the stock exchange. Again, to Seung Woo's point, well before the 1933 regs, like Reg T, Reg U, et cetera, that put limits, for example, on the amount of margin lending that could be done in the market. So it was already too late, right? What could have worked was simpler, and again, more bold regulation rather than relying on traditional regulation or on monetary policy. I think that's something we can take forward into today as well, that it's very difficult and maybe impossible and may have actually opposite effects to use monetary policy to try and curtail asset price rises that are based on shadow credit. And also that these policies are very difficult to implement politically. And just one more point is, these were the safest loans in the world, right? There was no deposit insurance at this time. So the fact that you really created a money machine, a real shadow banking market, which we thought we had in 2007-8, right? We thought we were, well, they thought, like I was a shadow banker then, we thought we were lending on AAA assets, but they weren't AAA, the safest in the world, but of course they weren't. And that was the start of the unwind. And again, very similar, we had so much leverage that had disconnected from the bank credit market, from the regulated system. Well, it hadn't disconnected completely, but it was on different terms in the regulated bank market, right? We had SIVs that had zero capital required, so it's infinite leverage. We had same thing with US investment banks, almost infinite leverage, right? So it was not a banking market that was taking these risks. But they thought they really believed I was there. We really believed we were lending on safe assets, just like they were doing in 1929. So on Seung's paper, if I can switch to that, I saw this paper as a very important history on the origins of the exorbitant privilege of the US dollar. And what I took away was a story of dollar dominance in the Eurobond market as a great example of how you decide where multi-causal explanations end and where the idea of accident and true path dependency and randomness begin. It's a story, if I got it right, of the abdication of Europe of its own domestic bond markets, right? When the French decided to use the US dollar, they were admitting that their domestic markets were ill-suited for the whole purpose they were intended, which was to raise money. I see that more as there was at times indifference, there's pragmatism, there was ignorance, some silly arguments that were made to why we would let the US dollar become the dominant capital market currency at the time. And I think it was rather this than what sometimes we think of as an intentional hegemonic power. And so I have a couple of questions about this period. I don't know this particular period that well, although I did trade Eurodollars and set LIBOR for a little bit of time, or helped to set LIBOR. Where did this US dollars go? Where did they go? Right. So it's more about what were you doing with those US dollars, right? We had two sides. We had the investors. Why were they investing in US dollars? I know there's the retail side, which is the tax arbitrage, Belgian dentists, and I guess an interesting part of it, but it can't be the whole story. Just like Wall Street Bet subreddit is not the whole story on why GameStop goes up. It can't be. There's not enough volume. So same story here. What was driving the investing side? And also it was driving the borrowing side, like how were these dollars being recycled? What were they doing with them, right? So if is this a story of FX swaps? Or is it something else?
I think we have like 10 more minutes to the next session. So maybe you can have like 5 minutes straight to respond to Anush's comments, and then Seung can reply to Rasheed's comments so we don't miss the next session.
Yeah, I mean, I feel there's so much to say, and I thank you so much, Anush, for bringing up those comments. But let me just sort of give you a flavor of Schacht in an anecdote. So he was once invited by a New York banker to come to New York and see, hey, come to New York and see how banking really works because there's so much money in New York. And then he said, hey.
And he's like, there's no money here. Come and this is real banking without any money. That's
exactly. And
that
you remember that quote? He then basically says in response, "Come to Berlin. There's no money there. Now that's real banking."
Awesome.
And that's and I think, I mean, if you start seriously reading Schacht, you can see the reason I used the phrase "thinking like a banker" because I was trying to square in a scientific, I was trying to get this through my economics department. So I had to somehow, my biggest problem with this thesis was not that I didn't understand what was actually going on. I could basically use the money view to sort of decipher these various policies. And basically, my contribution basically is in that of the money view is that you cannot disintegrate the domestic and the international story. And most of the studies I've seen would do that. I think some people and our friends who read my paper in MMT kind of latch on to the Mayfield piece without understanding that immediately this takes you into a massive problem of Germany doesn't have enough resources internally, and immediately we need to find a way to deal with this management of foreign currency. That's immediately the problem. Like in months, that's the issue. Had Germany retained its territories pre Versailles Treaty, it might have gotten away with it a bit better because the whole West was now carved off where all the coal and steel was. That was now French territory. So Germany could not. So I think Schacht is basically really so great at using he's educated, of course, in the old ways, in the old like Kindleberger. He has this hierarchy of payments as a banker. He understands money and credit. He understands liquidity. He understands payments. All of that is there. That's what I motivate in the first chapters. And from that, he's also an economist. He's got a PhD in economics, and he's squaring away this basic issue of S equals I. That's one important thing that he has to get at in the back of his mind on the one hand, but then also his intuition as a banker, of course, is a different one. So he has a little bit of struggle that we can dive into intellectually, which he's actually subconsciously trying to compensate for the fact that he at some point does have to equate S equals I. And he is comfortable doing that because he is in full control of the economy. And that's where it comes with central planning. He's in full control of the credit creation, and he's in control of the credit utilization. And that's why, because he's also minister of the economy in 34. So there is a full, he's basically attacking this thing from both sides. Intellectually, he hasn't resolved the issue that Keynes and Wicksell have a theoretical approach to, which is that with the introduction of credit, there's a multiplier, and eventually you can reconcile the investment side with the savings side. That piece by itself is lingering in the background, and he's super worried about inflation the entire time because all of these things scream inflation in his mind. And every grandmother and housewife and child is looking at the monetary aggregates, and he could not touch that in any way in order to facilitate his credit creation policies. Hence, the Mayfield bills and also the inflationary pressures had to all be relieved by taking all these forced savings schemes, Kraft durch Freude, which basically was sending everybody to vacation, but they couldn't buy anything. They can only sort of buy their Volkswagen by paying 5 marks a week, which they would never get delivered because they were using that they were just sucking the excess purchasing power out of the system. And he could then basically direct all exports to just be able to, and there's so much more. He's playing with all the par relationships. He's playing with various, the international side of things is so fascinating because it's breaking with all the intuitions we hold dear as a par, exchange rate, interest rate. He's manipulating that for his own purpose. And the interesting question would have been, had Germany actually not produced war goods but actual consumer goods, would this thing have worked? Would this not? Could he have squared the cycle of just actually being able to deliver on these credits? And from a tax perspective, actually, he would have been easily able to be paid back the Mayfield bills. That's not the point he makes. I think the the question I ask at the very end is very simple, to sort of ask, okay, what is the closest example we see today? And I think China is actually a very close example of where there is forced savings, but very clear business investment happening. But there is a very, very big difference as well, because in China, we're doing actual economic development. And this was purely a problem of already reactivating existing productive structures. So it's a very different problem, but I think still very interesting.
Thank you, Jay, for the comments. I think we should have one session for each paper because it's so much things to discuss on it. But I'll give the final word to Seung so he can reply to Rasheed's comments.
Thanks for your comment, Rasheed. And regarding your my answer to a question, where did the US dollar go? I think it was supposed to was everywhere. And what I found interesting was everyone kind of took the part of it. And what was going to say was the thing we known as the oil recycling, the practice. I think it was already in practice in the 1960s. So and the dollar went to like throughout various programs for military support or aids or grants, and then dollar was in, for example, in developing countries, and then they came back in London, for example, and then they will spread again. So everyone took a part of it. And what's interesting about the full policy implication of such a recycling and then this circulation of a US dollar around the global economy or financial market was the debate that I briefly mentioned. That kind of a structure or pyramid was creating a extra credit, which might endanger the stability of a global financial market. It was a big debate at least within the policymakers or central bankers at the BIS, as well as academia. And that was kind of interesting to examine, but I don't really have an answer at the moment because I'm just keep reading those arguments and then the records from the BIS. I think I can wrap up my answer at the moment.
Thank you. So I think then we can finish this session. I'm so sorry to do that, but let's think to move on this conversation maybe in another panel. So thank you again for joining us and the 4 presenters for the interesting presentations and the insights you gave us.